Something cracked inside the United States banking system this week, and almost nobody is treating it like the emergency it truly is. While most people were scrolling, sleeping, or arguing over headlines that don't matter, a regulatory report quietly landed inside a federal database. No breaking news banner, no urgent alert, no reassuring call from a bank manager, just a file, time-stamped and sitting in plain sight like a hidden tripwire waiting for someone to step on it. Inside that file was a number so disturbing it should have triggered alarms in every boardroom across the country. Losses large enough to swallow an entire equity cushion and still keep going. This was not a minor accounting adjustment or a temporary fluctuation. If those losses were recognized today, the institution would be economically underwater, insolvent in real terms, surviving only on paper and regulatory illusion. And this is where the story becomes dangerous. This is not about one poorly managed bank. It's a pattern, a system-wide math problem built into the structure of modern banking. That's why the phrase, "don't worry, it's contained," should make you uneasy. Historically, those words are spoken right before containment fails, and reality forces its way into public view. Analyses like this are often copied, diluted, and repackaged by channels that never dig into the source material. That's why Asian finance exists. The goal here isn't comfort or reassurance. It's to translate what the balance sheets are quietly revealing, long before headlines catch up. What matters isn't what officials say publicly, but what the numbers say when nobody is watching. Late Tuesday night, a regional bank in the southeastern United States filed its quarterly report. On the surface, everything looked routine. Assets, deposits, ratios, all neatly arranged and sanitized. But buried deep inside the schedules, where almost no one looks, sat the real story. A line tied to unrealized losses, combined with a heavy exposure to commercial real estate that simply does not work at current market prices. The figure buried in that report wasn't small, and it wasn't abstract. It sat in the tens of billions, quietly offset against an equity base that suddenly looked disturbingly thin. When you place those unrealized losses next to the bank's capital, the message becomes brutal and unavoidable. If the market value of those assets were acknowledged today, the bank would not just be weakened. It would be technically insolvent, operating with negative net worth in real economic terms. Yet the institution remains open, lights on, branches functioning. Why? Because modern accounting gives banks a powerful illusion. Assets labeled as held to maturity are allowed to ignore market reality as long as they are not sold. The loss exists, but it is hidden behind a regulatory curtain. It is the financial equivalent of refusing to check a home's value after prices collapse and insisting nothing changed because no sale occurred. That illusion, however, has an expiration date. It works only as long as liquidity holds and confidence remains intact. The moment cash is needed, the curtain gets pulled back. Assets must be sold. Losses that were once theoretical become real, visible, and irreversible. And this is where the story expands beyond a single balance sheet, because this dynamic is not isolated to one institution. These losses are spread across the entire banking sector, layered on top of a commercial real estate market that has quietly shifted from slow deterioration to accelerating infection. Office buildings, retail spaces, and large residential complexes financed under outdated assumptions are now colliding with a reality that no spreadsheet can smooth over. The problem is no longer hypothetical, it is structural. As of Friday, January 16th, 2026, this situation is not a conspiracy narrative or fear-driven speculation. It is the result of balance sheet math compounding over roughly 3 years, accelerating sharply over the past 12 months. Exposure piled on top of exposure, confidence stretched thin, and refinancing assumptions that no longer align with the world as it exists today. The system is approaching the point where containment stops working. When you combine the exposure across banks, the unrealized losses, the refinancing pressure, and the fragile confidence that can turn stress into a run, you arrive at a number that feels almost unreal when spoken out loud. Roughly $8.5 trillion. That figure is not meant to shock for attention. It reflects the scale of a system built on assumptions that no longer hold, and the cost of unwinding those assumptions when reality pushes back. To understand why that number exists, you need to see a banking crisis in layers. Most people only talk about the first one. The obvious layer is direct losses, loans that default, assets that must be written down, securities sold below cost. That's the visible damage, the part that shows up in headlines and earnings calls. But it is only the surface. The second layer is forced support. Bank resolutions, emergency liquidity programs, special facilities rolled out to stop the bleeding. None of that money appears magically. It is pulled from somewhere, created, guaranteed, or backstopped. Every option shifts risk and carries consequences, even when it prevents immediate collapse. Stability is purchased, not free. The third layer is spillover. Commercial real estate exposure does not live only on bank balance sheets. Those loans are packaged, sliced, insured, and distributed across pension funds, insurers, real estate trusts, and private credit vehicles. When valuations reset, the damage spreads sideways through this financial system, hitting institutions that never expected to be part of a banking problem. The fourth layer is the economy itself. When banks pull back, lending slows. When lending slows, projects stall, hiring freezes, and consumer stress rises. That is the moment when a quiet balance sheet issue becomes a recession story. When all four layers interact, the total destruction of value easily moves into multi-trillion territory, because the system was never designed to absorb a shock of this magnitude smoothly. This is where many people get misled. You will hear the argument that if interest rates come down, the problem disappears. That statement is only half true, and the half it ignores is the dangerous part. Lower rates can reduce bond losses and make refinancing slightly less painful, but they do not refill empty buildings. They do not revive office demand that vanished after the pre-2020 world collapsed. And they do not reverse years of leases expiring while tenants quietly shrink their footprints. Even if rates ease, the damage can continue moving forward. Many loans were written at valuations inflated by zero-rate financing, assumptions that no longer exist. Cash flows changed, demand shifted, cap rates moved. The math that once made those deals look safe simply does not work anymore. This is the cliffhanger most people miss. The system can survive a rate cut and still break banks because collateral quality and cash flow matter more than policy headlines, and speed matters more than people realize. When this kind of cycle accelerates, it does not give you months to react like it did in 2008. It gives you weekends, sometimes hours. A Friday night intervention followed by a Monday morning rebrand, while depositors refresh an app that refuses to load. Modern banking moves digitally, instantly, emotionally, and confidence can evaporate faster than capital can be raised. That is why the calm tone you see in official statements is misleading. Stability on paper does not mean stability in motion. Once stress reaches a tipping point, decisions are forced. Assets must be sold, losses must be recognized, and narratives collapse much faster than balance sheets can be repaired. What looks controlled on a Tuesday can unravel by Friday night. So instead of pretending this is isolated, the smarter move is to map the chain reaction step by step. Not to panic, but to understand what is breaking, why it is breaking, and what the next catalysts look like. Because this is not uncharted territory. We have already seen the early version of this movie, and the next act follows the same structure, just with higher stakes and less margin for error. We have already seen the first version of this story play out. In early March of 2023, Silicon Valley Bank collapsed. 2 days later, Signature followed. The lesson from that moment was simple but brutal. A bank does not need bad loans to fail. It needs a mismatch between assets and liabilities, and a loss that becomes real the instant depositors demand their money back. Back then, the primary trigger was securities. Banks loaded up on treasuries and mortgage-backed paper when interest rates were near zero. When policy rates surged in the fastest hiking cycle in decades, those low-coupon bonds were crushed. On paper, the losses were unrealized. But the moment withdrawals, forced sales, those losses became realized, visible, and fatal. That was the warning shot most people quickly forgot. The next wave is more dangerous because it is not mainly a duration problem. It is a commercial real estate problem. And commercial real estate does not heal quickly when it breaks. A bond keeps paying interest and eventually matures. An empty office tower does not refill itself, because a spreadsheet says it should. Vacancy is not a temporary fluctuation. It is a structural shift. The difference matters. If a bank holds a government bond that dropped 25% in market value, it can still hold it, collect interest, and receive par at maturity. The loss hurts, but it can remain theoretical unless forced selling occurs. But when a bank holds a loan backed by a building worth far less than the debt, with tenants leaving and cash flow collapsing, that loss is permanent. At that point, foreclosure does not solve the problem. The bank takes the property and discovers there are no buyers anywhere near the old price. That is where bids come in at 40 cents on the dollar, sometimes less. And that is how capital vanishes quietly, one impaired asset at a time, long before the public realizes what is happening. The story you will hear repeated is that commercial real estate is a problem, but a manageable one. That word manageable carries far more weight than it should, and the stress is not evenly distributed across the system. It is concentrated in regional and mid-sized banks that chased yield for years and treated commercial real estate as their primary profit engine. When that engine stalls, the damage does not spread slowly. It concentrates and then breaks. The exposure is also uneven across property types. Offices sit at the emotional core of this crisis. Remote work did not fade. Hybrid schedules did not quietly drift back to 5 days a week. The demand curve shifted permanently. And when demand shifts, valuations do not gently adjust. They reset. That reset is now showing up in loan performance, not as theory, but as missed payments and broken refinancing assumptions. Delinquencies on office loans held by banks have climbed sharply from their pre-stress levels. This matters because delinquency is a late-stage signal. By the time a borrower stops paying, months of negotiations, extensions, and quiet distress have already passed. Rising delinquencies do not mean losses are coming. They mean losses are already embedded in the system, waiting to be recognized. And the scale is massive. Banks across the United States collectively hold trillions in commercial real estate exposure. Offices represent a meaningful share of that total, and a large portion of those loans now sit in negative equity. The buildings are worth less than the debt against them. This is the moment lenders relearn an uncomfortable truth. Collateral only feels safe when it is liquid. An office building with empty floors is not liquid. It is not a safety net. It is a liability wearing a suit. And once lenders accept that reality, the illusion of stability begins to crack across balance sheets that, until recently, looked perfectly fine. Retail comes next. Yes, there are thriving shopping centers and prime locations that continue to perform, but a large portion of older retail space is structurally impaired. E-commerce did not pause or reverse. It permanently changed how much physical space is needed. Vacancy rates have climbed, foot traffic has thinned, and many marginal properties are being repurposed or quietly abandoned. If you assume even a conservative impairment rate across retail loan portfolios, the losses quickly move into the tens of billions. Then there is multifamily, long considered the safe haven. People always need somewhere to live, or so the logic goes, but multifamily is not immune to the same forces hitting the rest of the system. Higher interest rates, rising operating costs, and affordability pressure on tenants have changed the math. In several regions, overbuilding created surplus just as demand softened. Rent growth slowed, collections weakened, and margins compressed. Delinquencies in multifamily loans have risen. Not as explosively as in offices, but enough to matter when the exposure is measured in trillions. When totals are this large, even small percentage shifts translate into enormous capital impact. What once looked diversified now behaves like correlated risk, especially when the same macro forces hit every segment simultaneously. If you combine office impairment, retail stress, and multifamily pressure, you can build a conservative loss estimate that already runs into the hundreds of billions. And this estimate does not assume catastrophe. It assumes gradual recognition of reality, property by property, loan by loan, quarter by quarter. That alone is enough to strain bank capital. Now add the other side of the vice, securities losses. Banks still carry massive unrealized losses in portfolios labeled available for sale and held to maturity. Those losses shrink when rates fall and expand when rates stay higher for longer. The exact figure matters less than the vulnerability it creates. Assets are marked far above what the market would pay today, and that gap turns liquidity stress into solvency stress the moment cash is needed. This is where the system becomes fragile. When depositors pull money, banks need liquidity. When liquidity is needed, assets get sold. And when assets are sold, losses that were once hidden become locked in. This is why the combination of commercial real estate stress and securities losses is so lethal. One side erodes cash flow and collateral values. The other weakens the bank's ability to meet withdrawals without destroying its own capital base. But there's a third pressure point that most people still underestimate: the maturity wall. A massive wave of commercial real estate loans is scheduled to mature in the year 2026. These are balloon loans, structured over 5, 7, or 10 years. Originated when money was cheap and valuations were inflated. As they come due, borrowers face hard choices that cannot be postponed. The first option is to pay the balance in full, which most cannot do. The second is refinancing, but refinancing now requires appraisals that support lower valuations, higher equity contributions, lower leverage, and stronger cash flow coverage. At the same time, properties are appraising lower because demand weakened and capitalization rates moved. That creates an equity gap that many borrowers simply cannot fill. The third option is default. Handing back the keys becomes a rational decision when equity is already gone. This is not a future risk. Strategic defaults are already happening, and they accelerate once borrowers realize the math does not work. Fighting only delays the inevitable and drains cash that cannot be recovered. The maturity wall forces resolution. It turns "we'll work it out" into pay up or walk away. And when hundreds of billions of dollars hit that wall in a narrow window, the system does not have the capacity to refinance everything, even if it wants to. Defaults rise, losses get recognized, and capital takes the hit all at once. At this point, many people nod and say, okay, there are losses, but they underestimate the force that turns losses into a full-blown crisis: contagion. Banking is not just about assets and liabilities. It is a confidence business. It runs on the belief that money will be there the moment someone taps transfer. Once that belief weakens, behavior changes instantly. We saw this dynamic clearly in 2023. One bank failure created fear. Fear triggered withdrawals. Withdrawals forced asset sales. Asset sales made losses visible. Visible losses created more fear. That feedback loop is the doom spiral. And in the year 2026, the setup for that spiral is far more dangerous than it was before. The reason is simple. The commercial real estate damage is no longer theoretical. Office buildings have already been repriced. Defaults are public. Distressed sales are printing shocking numbers. This is no longer a rumor circulating in analyst notes. It is observable reality. And once reality is visible, depositors do not wait for reassurance. If 2 or 3 regional banks are seized in the same weekend, customers at similar institutions will not wait for a press conference. They will do what people always do in uncertainty. They will move toward what feels safest. That means deposit flight into the largest banks. And here's the cruel irony. Even if the biggest banks remain stable, the act of fleeing destabilizes the smaller ones. Withdrawals force sales. Sales realize losses. Losses weaken capital. Weakened capital triggers more fear. The cycle feeds on itself. This crisis is not just about loan defaults or real estate valuations. It is about the speed of digital fear, where millions of decisions are made simultaneously, without coordination, at the speed of a mobile app. To understand why this risk is so uneven, you have to look at concentration. Thousands of banks operate across the United States, but they are not built the same. Many small and mid-sized institutions carry commercial real estate exposures that are enormous relative to their equity. Regulators define thresholds for high-risk concentration, and a meaningful number of banks sit well above those lines, even if they look healthy on the surface. This is what makes these institutions dangerous in calm periods. A bank does not need to lose half of its assets to fail. It only needs to lose enough to erase its equity cushion. And equity is a thin slice of the balance sheet. When exposure is concentrated, a loss of 10% in one segment can be catastrophic. The damage does not need to be widespread. It only needs to be deep. These banks can appear stable right up until the moment they are not. Capital ratios look fine. Liquidity metrics pass basic tests. But once losses move from paper to reality, the margin for error disappears instantly. This is why crises always feel sudden to the public, even when they have been building quietly for years. This is also where the capacity of the deposit insurance system becomes a real question. The deposit insurance fund sounds massive in isolation, but it is small compared to the total pool of deposits it promises to protect. In normal times, that is not a problem. Failures are isolated, assets are sold, and the fund replenishes over time. In a clustered failure scenario, the math changes fast. The moment multiple banks fail together, the problem stops being technical and becomes political. And when that happens, the true backstop is no longer the insurance fund. It becomes the treasury and the central bank. That shift carries consequences, including money creation and inflationary pressure, even if those effects show up later rather than immediately. The next question is timing, because this is where most people get caught reacting instead of positioning. Over the next several months, the commercial real estate reset is likely to move from a niche sector story into a headline event. High-profile office buildings in major cities will hit the market at prices that look like mistakes. Towers once valued in the billions will trade for fractions of that, and each sale will set a new benchmark that forces appraisers to mark down similar properties. Banks do not need every building to default for stress to spread. They only need a pricing environment that forces recognition of lower collateral values and tighter refinancing terms. Every distressed sale creates pressure on the next loan, the next borrower, and the next balance sheet. That is how valuation spirals accelerate quietly without a single dramatic announcement. At some point, likely on a Friday evening, the first seizure weekend will arrive. One or more regional banks will be closed after the markets shut. Deposits will be transferred. Operations will resume under a new owner or a temporary bridge structure. The language will be calm and technical, unsafe practices, insufficient capital, orderly resolution. But the market will understand what those words really mean. The losses became too large to hide. That weekend will not stay contained to the institutions involved. Every bank that looks similar will be judged by depositors instantly. People will not wait for clarification. They will ask a simple question in private group chats. Is this our bank? And once that question is asked, behavior changes before any official response can catch up. By the time Monday arrives, the stress will already be in motion. Most customers will eventually regain access to their money, but eventually can include frozen cards, delayed payroll, or online portals showing incorrect balances during system migrations. In calm times, those glitches are annoyances. In stress times, they become the spark that pushes people to move money preemptively. Once movement starts, the most dangerous phase begins, the silent run. There are no lines outside branches, no television cameras, no visible panic, just millions of small digital decisions happening at the same time. Transfers executed in seconds, deposits bleeding out quietly, invisibly, at the speed of an app refresh. This is the new rhythm of banking stress, and it is far more lethal than the slow-motion crises of the past. This is why panic today feels different. Banking used to move at walking pace. Now it moves at Wi-Fi speed. Confidence can vanish in hours, not weeks. And if you're wondering how to identify vulnerability before the headlines hit, the answer is uncomfortably simple: concentration and capital. A diversified bank with a thick equity buffer can absorb shocks. A concentrated bank with thin capital cannot. When commercial real estate exposure is several times larger than a bank's equity, one bad year can erase the entire cushion. That is why ratios matter more than predictions. You don't need to forecast exact default rates. You need to know whether an institution has room to absorb surprises without being forced into asset sales that destroy capital. This is also why real-world observations matter. People working in banking, commercial lending, property management, or construction see stress long before it becomes public. Extensions requested quietly. Appraisals coming in far below expectations. Lending standards tightening behind the scenes. These signals rarely make headlines, but they are the early tremors that precede visible breaks. Understanding this phase is not about fear. It's about awareness. Because once confidence cracks, the system does not slow down to let anyone catch up. It accelerates, and decisions that could have been orderly become rushed, emotional, and irreversible. As the year moves deeper into the heavy refinancing window, assumptions collide with reality. Many borrowers built their entire strategy around the belief that interest rates would be meaningfully lower by the time their loans matured. That belief is now being tested. Even if rates drift down slightly, the environment has changed. Credit spreads are wider, underwriting standards are stricter, cash flows are weaker, and valuations are lower. Refinancing today is not just about the rate, it's about whether the property supports the loan at all. Lenders now demand more equity, lower leverage, and stronger debt service coverage. At the same time, appraisals reflect higher capitalization rates and reduced demand. That creates a gap between what borrowers owe and what the property can justify. For many, that gap cannot be filled. When negotiations fail, the next step is extension, modification, or default. Extensions buy time but rarely solve the core problem. Modifications shift losses forward but do not erase them. Defaults, once avoided, become rational decisions when equity is already gone. Handing back the keys is no longer emotional. It is financial triage. Each default forces banks to act. Loans must be reclassified. Reserves must be increased. Write-downs must be taken. One by one, these actions erode capital. Individually, they look manageable. Collectively, they compound into systemic stress, especially when hundreds of billions of dollars face the same maturity wall within a narrow time frame. This is how slow pressure turns into sudden breaks, not through one catastrophic event, but through thousands of forced decisions happening simultaneously. The refinancing wall does not announce itself loudly. It simply removes options until only the most painful ones remain. This is the moment when the public narrative begins to shift. The conversation moves from "a few banks had issues" to a far more uncomfortable question: is the backstop enough? A single failure rarely scares people. A cluster does. When multiple institutions fall within a short window, confidence stops being abstract and becomes personal. People start asking where their money actually is, not where they were told it is. When discussions turn toward deposit insurance capacity, psychology changes fast. The insurance fund sounds reassuring until it is compared to the size of the deposits it promises to protect. In calm times, nobody cares about that math. In stressed times, everyone suddenly does. Officials reassure, markets listen, but do not fully believe, and that gap between reassurance and belief is where pressure builds. This tension pushes depositors toward what feels safest. Money moves upward, toward the largest institutions, not because those banks are perfect, but because size feels like protection. Ironically, that behavior makes the smaller and mid-sized banks weaker. Deposits leave, liquidity tightens, asset sales become unavoidable, losses that were theoretical become real. At that point, policy responses follow familiar patterns. New facilities appear with comforting names, liquidity programs, stabilization tools, transition support. The mechanics are always similar. Troubled collateral is accepted, lent against, or purchased at prices higher than the market would otherwise offer. This is a backdoor bailout. It does not erase risk, it transfers it. The immediate panic may be contained, but the cost does not disappear. It shows up later in slower growth, tighter credit, and lingering fragility. Stability is restored on the surface, while the system underneath becomes more cautious, less dynamic, and more defensive than before. This is the phase that rarely dominates headlines, but causes the deepest long-term damage: zombification. Banks that survive the acute stress do not emerge confident or aggressive. They emerge cautious. Capital becomes something to protect, not deploy. Lending standards tighten beyond what fundamentals alone would justify. Risk appetite collapses. Credit stops flowing where it once moved freely. When banks pull back, the effects ripple outward. Fewer loans mean fewer projects. Fewer projects mean slower construction, delayed expansions, and shelved ideas. Small and mid-sized businesses feel this first because they rely on bank credit more than large corporations do. Growth slows quietly, not with a crash. but with a persistent drag that is harder to reverse. This is where historical parallels matter. After 2008, the panic was sharp, but the recovery was slow and uneven. In Japan's lost decade, the crisis never fully exploded, but stagnation lingered for years. Zombified banks kept weak assets alive, delayed recognition, and starved the economy of productive credit. The surface looked calm. The system underneath slowly decayed. Even if authorities succeed in stopping panic, they cannot stop this phase easily. You can print liquidity, but you cannot print profitable demand. You can guarantee deposits, but you cannot guarantee the cash flow that made loans viable. You can delay losses, but you cannot erase them. And the longer recognition is postponed, the longer the economy pays the price. This is why the real cost of a banking crisis is not measured only in failures. It is measured in lost momentum, suppressed opportunity, and years of cautious behavior that follow. The damage is not loud. It is slow, persistent, and deeply structural. So what does this actually mean in real life? Not in theory, not in headlines, but in practical terms. First, understand insurance limits. If more than $250,000 sit in a single bank under the same ownership category, the amount above that limit is not protected in the standard way. In calm periods, this detail is ignored. In stressed periods, it becomes a serious risk management question. Second, do not assume access is instant. Even insured depositors can experience short disruptions during a bank resolution. Systems change, cards pause, payroll batches get delayed, online portals glitch. Usually it's brief, but brief can still hurt if it hits at the wrong moment. Keeping a modest cash buffer for essentials is not paranoia, it's redundancy. Third, know your bank's exposure. You don't need to be an expert. Call reports are public. They show commercial real estate categories and equity capital. The ratio between the two tells you whether a bank is heavily concentrated. High concentration means higher sensitivity to losses. That alone changes how much margin for error exists. Fourth, business owners need to pay attention. If payroll depends on one institution, that is a vulnerability. If operating cash sits in a single account, that is a vulnerability. Having a second banking relationship and the ability to move funds quickly matters far more than most people realize. Waiting until stress appears is exactly when systems are crowded. Fifth, property owners, with upcoming maturities, should act early. Refinancing markets reward preparation. When many loans hit the same window, lenders choose the strongest borrowers and best assets first. Waiting compresses options and increases losses. Early negotiation creates flexibility when flexibility is still possible. Investors also need to be precise about where risk is hiding. Instruments tied to commercial real estate cash flows can look stable right up until valuations reset. When that happens, dividends can be cut, debt can be restructured, and securities can reprice violently as defaults rise and refinancing freezes. The danger is not volatility alone. It is discovering exposure after liquidity disappears. This is why understanding the broader macro picture matters. For more than a decade, the global economy was built on cheap money, interest rates near zero, central banks expanding balance sheets, liquidity everywhere, asset prices inflated across stocks, bonds, real estate, venture capital, and private credit. Low rates were treated like gravity, something permanent and unquestionable. Then rates moved. And when rates move, everything financed cheaply must adjust. The stress does not hit all at once, it travels. First, long-duration assets cracked, then specific banks broke. Now commercial real estate is revealing the hidden cost of the last cycle. Each phase exposes leverage that only worked under conditions that no longer exist. The banking system sits at the center of this process. It is the transmission belt. When banks become cautious, credit tightens. When credit tightens, business is slow. When business is slow, hiring cools. When hiring cools, consumers pull back. When consumers pull back, defaults rise. And those defaults feed straight back into banks. That is how a property problem becomes an economy problem. This is not a call for panic. It is a call for attention. The most dangerous moment in any financial cycle is not when everyone is screaming. It is when the cracks are visible, but the majority is still pretending nothing is wrong. The quiet phase is when positioning happens, not through reckless bets, but through awareness, diversification, and resilience. There is one final layer that matters more than spreadsheets, models, or forecasts: psychology. The first major bank can reveal massive hidden losses, and most people will shrug. The second raises eyebrows. The third changes behavior. That is when the question appears quietly in people's minds. How many others look like this? And that question is the match that lights the fire. Depositors do not have time to audit every institution. They make a simple emotional decision, move toward what feels safest. That movement itself becomes the event. Confidence does not collapse gradually. It flips. One day systems feel stable. The next day transfers surge, apps slow, and rumors spread faster than facts. This is why modern banking stress rarely feels slow. It feels like a switch being thrown. This is also why preparation matters before urgency. Redundancy built in calm periods works. Redundancy built during stress fails. Knowing where cash sits, how diversified exposure is, and how quickly funds can be accessed on a bad weekend becomes more important than predicting the exact trigger. The first real signal is rarely a headline. It is an outage, a delay, or a quiet warning passed through private conversations. A bank can look healthy while hiding losses. A system can look stable while pressure builds, and markets can look calm right up until the moment they are not. The report that surfaced this week was not the crisis itself. It was evidence of one, a brief flash of light inside a dark room, revealing shapes most people were not meant to see yet. The takeaway is simple. Do not ignore what the numbers are quietly saying. Do not rely on perfect responses from institutions under stress. Manage exposure, diversify relationships, understand guarantees, build resilience before it is needed. The people who navigate chaotic cycles best are not the loudest or the fastest. They are the ones who saw the shift before it became consensus. If this analysis helped you see what most people are still missing, don't leave now and don't come back later. Cycles like this don't give second chances. Subscribe to Asian Finance and stay ahead of the curve, not reacting after the damage is done. Leave your perspective in the comments. Your insight matters more than you think. And if you want to go deeper, the next video is already waiting for you.